Welcome back, everyone, to week 5. We're going to do this a little bit differently this semester. I have some notes, and because this is a chapter that is heavily income math based, I wanted to show you guys in some different slides that we have done and presented for you in order for you to get a better idea of this chapter, which again, like chapter 4, is relatively long, so I recommend breaking it up into 2 or 3 chunks to make it more easier to manage. So this chapter, the financial aspects of property management, we talk about a few things. We talk about accounting practices that we normally use. We also talk about trust funds, gross income and operating income, net operating income again. I know we've talked about that again before in previous chapters. We talk about cash flow, preparing annual operating budgets for our owners, financial reports, and income tax ramifications of real estate. So the first chapter section here, we talk about accounting, and this is important in property management because we have to learn which accounting style we are going to be adopting as property managers. There are basically 3 accounting methods. The first would be the cash basis accounting. That's where income is recorded when it's received and expenses are recorded when they're paid. So cash meaning cash basis, cash when we get it, expenses when we pay it. That's how I always look at the cash basis. The second one, accrual basis, is when income is recorded when it is due, such as when the rent is due, and expenses are debited monthly as they accrue, but not necessarily when they are paid, just as the expenses accrue. So income when we get it, expenses when they accrue. That is more the accrual basis method, and that's the way I always remember it. Modified cash basis accounting is a variation of our cash basis accounting. Income when we get it, but expenses when they accrue, similar to the accrual basis accounting. And there are multiple versions of all forms of this accounting practices. If you've ever taken an accounting course, you can find 6 or 7 wonderful accounting methods. But these are the 3 basics that we cover in this section. If an owner wanted to change the accounting method they would use, sometimes they would need to obtain approval from the IRS. So you have to decide up front which one you're going to be used. If you're going to be using one of these forms of cash or accrual or modified cash basis, you cannot commingle accounts. And there are wonderful accounting software that you can use to manage any of these types of accounting that are just great. Trust funds. We also talk about trust funds. That's all money held on behalf of the client. Now keep in mind, none of this money can be commingled. We cannot commingle our deposits with our expense account, with our reserve account. We can't commingle it with our own accounts. We can't commingle it with multiple tenants' accounts. It has to be labeled correctly. Or if you have one general business account for one specific client, at least you have it labeled correctly as a trust account, and that is for that specific client. It's not for multiple clients. Operational account, that's all of those funds that we use to pay for those expenses that we have as property managers. A reserve account is what we have for big improvements on a property. Let's say you have a roof that needs to be repaired within the next 5 to 10 years. You're going to start putting money into that reserve account right now in order to save up to pay that roof repair, that roof completion in 5 to 10 years down the road. The same with the security deposit. We want to make sure that that is managed correctly, and we have labeled that as security deposit in our software. So if the time comes up where the lease is up and the tenant no longer wishes to renew, then that security deposit should be refunded accordingly, which is within 21 days after the end of the lease terms. The FDIC, I don't know if you guys have seen those on commercials or on bank doors. When you go into a bank, it says FDIC, and what that means is Federal Deposit Insurance Corporation. That's up to $250,000. So all bank accounts used for clients' funds should be federally insured. Deposit insurance may be required by the management agreement or the state licensing law, which it is. It is required up to all accounts of $250,000. Now, limits apply individually to each owner or client who has funds in a trust account combined with other funds in the individual account that has held on deposit with that institution. So that's why a lot of owners have multiple banks or multiple accounts with each client so they can meet that threshold of $250,000 and they don't exceed that. Anything over that is obviously not insured, and you'd have to pay for an additional insurance. The next section we talked about in Chapter 5 is the gross income. What is gross income? Well, that's the amount of money earned by a property manager before expenses have been paid. So think of it as gross as being the total money that we get from in the form of rents and other funds on an annual basis. So what do we mean by annual funds? Well, that could be laundry services that are on site, that could be vending machines, that could be parking, that could be storage, anything else that we are charging for rent or some kind of form of income that will go towards our gross income for the owner. Operational expenses. Operational expenses are the costs of maintaining, operating, and managing an income property. That's all the expenses paid for operating. Usually we don't include the debt services, and what we mean by debt services is the mortgage that are out on the property or the debts secured against the property, whether that be a lien or whether that be a refinance that you've taken out additional funding on the property. That's debt services. We don't include taxes or capital expenditures. We're going to label that separately further down in our operating income because it depends on where the property is held, what those actual operating expenses will be. So our operating expense ratio is a good method, a good way of determining what we are going to be getting for this particular property. So it's a percentage of our effective gross income that represents the property's operating expenses over time. It's pretty easy to determine. You take your operating expenses and you divide it by your gross income to get your operating expense ratio. What that is it tells you how high your expenses are for that property. So for example, if we have a property where we're getting rental income and additional income per year of $12,900 and our operating expenses for that year is $9,000, we take our $9,000, our operating expenses, we divide it by our gross income, which is the $12,900, to get our ratio of 0.06976, or basically 69% of our gross income is spent on operations. So do you think that's a good operational expense ratio for a property? I'll let you think about that. Within those expenses, we have two basic formats. We have variable expenses, which is basically just maintenance, as well as fixed expenses, which is property tax insurance. We don't really always know what maintenance will be for a particular year, what the cleaning, what the expenses, what'll go broken or will have to replace within that year. So it could be variable. Fixed usually is pretty consistent, such as property taxes and insurance. We know and we can project what they will be for the upcoming year. It's difficult for property managers a lot of times in certain areas to determine which is variable and which is fixed. A lot of times you'll see it summed up or lumped together both fixed and variable. That's basically when a property manager is having a hard time determining if they're fixed or variable. Special assessments for particular areas that have Melleroos or that have special assessments due to a school bond can vary on location and the amount of time that has elapsed for that bond to be paid. Utilities can change over time depending on what the utility company is doing that year, whether there's been additional expenses on our behalf or not, as well as maintenance, cleanup, and repair can change. So we're going to also talk about in this chapter what we have talked about in the previous two chapters, which is our net operating income. Does anybody remember what that stands for, the abbreviation for net operating income? NOI. So you should know that pretty well, that net operating income is NOI, or NOI is net operating income. That's the amount of money from rents or other income left over from our gross income after paying all of our operating expenses. So we take that gross income, the amount of income we get, we subtract our expenses to get our NOI. This is a really good way of determining how much money we have left over after our income. After we get all of our income for that full year and we pay out all of those expenses, how much money is left over? That is our net operating income. How much money has come in less expenses? The return on investment is also a measurement that we use. Essentially what it says is the interest rate that we paid on the money that the owner has invested in the property. So in order to determine that, we take our net operating income, that's our income after operating expenses, and divide it by our capital invested. How much money a property has been purchased at to get our return on investment. So if we take our net operating income of $12,000 and we divide it by our capital investment of, let's say, $200,000, we're going to get our return on investment that we have on that property. So as property managers, our biggest concern is how do we get these owners the biggest return on their investment? How do we increase their gross income? How do we decrease expenses to get the bigger cash flow into their pocket? And that's difficult. It depends on each particular property. Increasing gross income usually can be accomplished by increasing rent, improving occupancy rates, increasing collection rates, adding additional leasable space, or increasing miscellaneous fees. A lot of property managers have used that now as a miscellaneous fee on some leases that they charge to their tenants. So that's how most property managers increase their gross income. Another way to increase the NOI, the net operating income, is by decreasing expenses, such as property taxes, insurance, utilities, or other services. If you do the maintenance on the property yourself, are you paying anybody to do that? Well, you are getting the income after expenses have been paid, but that's decreasing your maintenance fee. If you file a property tax appeal and are successful in decreasing your property taxes, that's one way you can decrease that fixed assessment on your income. If you're able to shop around for cheaper insurance, that'll decrease your expenses and therefore put more money in that owner's pocket. The property manager then usually gives the full amount of the NOI, the net operating income, to the owner each month. The management agreement may then determine if there's a certain withholding for debt services, and what we mean by debt services is the amount of mortgage that's on the property or refinance or any type of lien that needs to be paid. Cash flow is the amount of spendable income generated by an asset after these expenses have been paid. So our gross income is the total amount. The net income is after expenses have been paid. The cash flow is what we get after the debt services have been paid. That is the amount of money that gets generated to the owner's pocket. The after-tax cash flow we could also determine after the income taxes are paid on a property's income. So the annual operating budget that we have is a budget that sets out this property's expected income for operating expenses each month and for the upcoming year. Zero-based budgeting. What is zero-based budgeting? Well, this is a budgeting used when we have no previous information on a property's income. What do? Well, we have to project that. We have to recreate what the property's potential gross income is, what the potential expenses are, subtract the expenses from the gross income to get our net operating income. That's basically recreating this process that we have already. That's known as zero-based budgeting. Financial reports. These are reports typically submitted to the owner on a monthly, or it could be a quarterly, or an annual basis. It could also be shown as a cash flow report, a profit or loss statement, earnings statement, or an operations statement. These reports basically summarize our income and expenses that have accrued annually or monthly or weekly, depending on how often you submit this to the owner as determined in our agreement. So the content is usually agreed upon with management up front, what they want to hear from, what they want to see. Most of these reports include a summary of operations, a rent roll, which shows who are the tenants on file and how much they have paid each month. A list of the owner's contributions, could be a statement of receipts, a reserve account report, a budget comparison, or a narrative of any operations that have developed over the year. The reports could be simple, using single line items to make the budget comparison easier. And there are wonderful property management software that help you prepare these reports on a monthly, quarterly, or annual basis. And I have also attached that in, I believe it was 2 weeks ago, as an article on the best property management software there is. The budget comparison statements assist the manager in identifying any problems within this budget so they can justify why expenses are higher on one month versus another. The manager may also need to prepare an annual income, an expense statement for taxes for this owner. And this comes into play with the financial software that are available, determining on how much of this we can actually write off. So what do we mean by write off? Well, we mean tax deductions, right? So there are 4 important tax deductions available to property owners for property management. The first one would be depreciation. What is depreciation? Well, that's a loss in value caused by physical wear and tear over time on a property. It deducts for aging of a property. It does not deduct for the land, only the improvements of the property. For residential property, it's 27.5 years that you can deduct the property improvement values over the lifespan of that property. For non-residential commercial property, it's 39 years. Mortgage interest rates and points are deducted for IRS tax purposes. Operational expenses are usually fully deductible. Any expense that you have paid on this property, you can deduct on your taxes. Isn't that wonderful? As well as operational loss. And that's when annual expenses exceed your annual income. You can deduct that from your tax deduction. Pretty cool, huh? Yeah, that's one of the great things about owning property if you have managed it for income purposes, is all those four important tax deductions that are available to investment property owners. So what type of income is rental property? Pretty easy, right? That's passive income. You don't really have to do much and you receive income on a monthly basis. It's income the taxpayer would earn from an enterprise that you really don't participate in other than generating and collecting those rents. It's considered a passive income. Passive losses are deductible from passive income. So if our expenses outweigh the income, then we can deduct that on our taxes. The amount of gain on tax gains. This is where we get into some touchy issues with IRS, because just when you think that you have all the IRS rules down for property management and investment purposes, they go and they change those rules. So every year what I do is around January, February, I order the publication 17 from the IRS, which is a big packet of information, a big booklet that you read through where it tells you any changes for the upcoming year. And this is an important section for us as property managers because it talks about tax gains and what the owner must pay on any income tax gains from real property, whether that be the sale of investment property, whether that be income gains or depreciation. The amount of gain is determined by taking your sales price of the property minus your adjusted basis, which is the amount of money that you have put into the property for the maintenance, would be your gain or your loss. So if you have invested more money than what you bought it for, you obviously have a loss, and that is tax deductible. So the owner pays income taxes on any gains from the sale of property. However, there are a couple of exceptions that I have found over the years. And the first one would be loss. If we have paid out over and above expenses than what we have sold the property for, even if it's for a number of years, we could have a loss, and that would be deductible from any gains on any other income that you have. Now, granted, if you have a loss and you have no other form of income, you can't deduct anything from zero. They're not going to basically give you any further deduction if you don't have any type of other income. The second one would be if the property was owner occupied. So if you occupied the property within the previous 5 years, but after that it was a rental property, then you're exempt from the property tax gains on the IRS. So those are just a couple of things that I have found over the years that have been really great when it comes to reporting that information to the IRS. Now, the IRS classifies all real estate as basically a capital asset. Therefore, if you sell it and you have a profit, it is a capital gain. Short-term gain is when you have owned the property for less than a year, and a long-term is if it's more than a year. Well, I hope this has helped with some of these issues with this chapter and a little further discussion. Please complete and read the chapter and go and do the 5 essay questions and the 10 quiz questions. All of these questions are from the book, as well as it will be in the final at the end of the semester. I'm available Mondays from 6:30 to 7:30 in room E229. I hope to see you guys soon. Have a good week. Bye-bye.